We now have over $1 trillion of capital sloshing around global capital markets with various brands of sustainability and impact. And you can't say that this hasn't gone mainstream as a practice. We have shown that you can raise billions of dollars of impact capital, but we have not shown that you can create billions of dollars worth of impact. You have folks who say, I want to optimize for financial performance, and I'm going to do that, but I don't want to be called an impact investor because all kinds of stuff kicks in from the regulatory side. And so you have what some folks are calling impact hushing or green hushing, where people are actually using these practices, but they're not lifting them up and marketing them as such. All companies are, in essence, blended value companies. Value is fundamentally whole. It's a blend of social, environmental, and financial factors. What has happened over, let's say, the last 15 years has been a real movement around getting better standards, getting better regulations in terms of when you use the term impact and sustainable finance and are branding your products accordingly. Do you really have sustainable investment strategies within those products? Or are you just taking an existing offering and putting another label on it?
Good to see you again. And to prepare for getting together today, I actually watched our talk from, I guess it was about 4 years ago now. And a couple of things struck me. One was that somehow you and I somehow looked younger in that video. And I don't understand that because you go to the gym, I go to the gym. I don't get that. But in that conversation, you told me that you go through something like 5-year cycles in your life where you feel that you answered the questions that you felt you needed to answer at that point in time. And then somewhere around 5 years, you come to a point where you feel a strong need to find new questions to answer. So it seems like one of these cycles may have more or less run its course since we last saw each other. Have you answered some questions since the last time I saw you, and are you in search of new questions at this point?
It's a great way to get into the conversation, Scott. So thank you for that. And again, it's great to be with you. I would say yes. I would say that what brought me into the firm that I'm currently with, AlTi Tiedemann Global, was the realization that we had scaled impact investing as a field. We now have hundreds of billions of dollars, in fact, over $1 trillion of capital sloshing around global capital markets with various brands of sustainability and impact and SRI, ESG. And you can't say that this hasn't gone mainstream as a practice. But the way I think of it is we have shown that you can raise billions of dollars of impact capital, but we have not shown that you can create billions of dollars worth of impact. And so the challenge for the field, I think 5 years ago, was how do we take impact investing at scale and ensure that we're actually executing with integrity, with real impact, if you will, relative to what we have said we want to do. And how do we do that at a level that's commensurate with the size of the challenges that are before us today, whether it's climate crisis or social inequity or any particular subset of those considerations? We really need to be mobilizing capital at scale, but it doesn't matter if we are doing that and then not achieving impact. So this issue of the integrity of our practices, I think, is an important one. And if you're going to pursue that path, you really have to do it, to my mind, through larger institutions. You have to be able to connect at scale with infrastructure that has an ability to move capital around the world in a way that is effective. And so that's why I left my previous life. For about 22 years, I had a portfolio lifestyle of academic appointments, advisory roles, working with family offices. Left that life for AlTi Tiedemann Global, coming in-house, if you will, with one firm and really focusing on how to work with colleagues to execute that vision of impact integrity at scale. And that's what I've been doing now for the last 4 years. And now the wheel turns again. So it continually goes. But for the last 5 years, that's really what I've been exploring in terms of a set of questions, really, as opposed to answers.
But another thing that struck me when I reviewed our last talk is you've had one of these career trajectories that sounds like a thought experiment come to life. You started out, I don't know exactly how many years ago, maybe 30 years ago, by founding a homeless youth program in San Francisco's Tenderloin district. And then fast forward, ended up working with some of the wealthiest families in the world. And all that happened before you got to Tiedemann. Why don't you briefly share that story for listeners who are listening who aren't familiar with you so they get the high level understanding of that odyssey that you've been on?
I have to say, the older I get, the harder it is for me to be succinct in doing my bio because it gets longer and longer. But in any event, so I was raised in the New York City area. My dad was a minister. My mom was a social worker. All I wanted to do as a kid was change the world. I was in my first anti-war march when I was in third grade. By seventh grade, I was working as a peer tutor in Spanish Harlem in New York City. That then ran a trajectory of youth and community development. At 25, I launched Larkin Street Youth Center in San Francisco, was brought out actually by a group of community organizations to lead that effort, did that for 4 or 5 years, and was left at this place of real pride with what we had done. This was during the AIDS epidemic, very challenging time to be working with street kids and teenage prostitutes. And we did a great job, and the organization continues to do wonderful work with street kids. But I really reached a point where the way I thought of it was that in the nonprofit sector, money moves on the basis of politics, perception, and persuasion, but not performance. And I felt that I was part of this, in some ways, a large deception around this dance of deceit where you've got this great program, but you have to be continually like turning it so that it appeals in certain ways to various stakeholder groups. And all we want to do is good work, right? And so a lot of times money would not necessarily move to the actors who were doing the best work, but the ones who could wire a grant process or had the best political connections or had the best kind of media presence, all this kind of stuff. And fine, like that's part of how that works. And that is less the case today than it was 40, 50 years ago. But having said that, I decided I needed to do something else if I wanted to change the world. I did not want to stay in the traditional nonprofit space. I then through a variety of things. So I left in a responsible way, and then through a variety of different conversations, ended up in a series of discussions with the guy, George Roberts, who's the R of KKR, the private equity firm. And George, oddly enough, had come to a very similar place, but obviously from a very different path. And he was feeling that a lot of the ways that he was being offered to do things with his wealth were almost antithetical to his values and beliefs and how he had created that wealth. He really wanted to explore an alternative to traditional kind of charitable giving. And so we started a conversation in 1989 around what would it look like to manage philanthropic giving as a form of investing and to use kind of business acumen, skills, and practices to drive community change. And so we then set up a fund that was a private fund with George's capital that I ran for 11 years, where we would take the money, we would invest it in small for-profit enterprises that were owned by nonprofits, providing transitional employment to formerly homeless people. And so that was a whole nother adventure that we could talk about. The important part of that conversation, just to set the context maybe for a little later, is woke up and realized that I felt like I'd been having the same conversation with all these different people, for-profit social entrepreneurs, nonprofit social enterprise, social investors, venture philanthropists, I mean, all these different actors, and all of whom thought they were very distinct and different. But I realized that to me, they all looked the same. And what I realized was the commonality is that I had gone to a place where I didn't really care if something was a nonprofit or a for-profit. I didn't care about a grant versus an investment, because for me, they were all organizations that were grappling with a bifurcated value proposition. And what we were asked to do in the world is either do well or do good. You either work for a nonprofit or a for-profit. And in reality, organizations create multiple types of value. So I became very focused on this notion of blended value. That then set me off on another course for academia and writing and publishing. And I ended up working with families, because families don't think in bifurcated terms. They think in terms of their wealth. They think in terms of their family and what they want to advance in the world with their wealth. And that can be through a company. It can be through a foundation. It can be through an impact investing group. And so I ended up really accidentally working in the family office space for about 15 years and writing again a whole series of articles and books around that work. And then that's what brought me to the pandemic and the moment where I decided I wanted to go inside and try to drive this within one organization. So that's how I ended up at AlTi.
And that's just the 30,000 foot view of your story. And if anyone in the audience wants to hear a whole lot more about your odyssey, and I highly encourage it, there's a lot more detail in episode 3 of the SRI 360 podcast, and I'll put a link to that in the show notes. Since we spoke, a lot has happened in your world since that point in time. At that point, you were the managing director and global lead for impact investing at Tiedemann Advisors. And now your title is Chief Impact Officer. So it sounds like you're the big enchilada now. What's the story? I know a lot's happened. Tiedemann merged with Alvarium and created AlTi. Is it AlTi Tiedemann Global?
Tiedemann. Yeah, exactly.
How do you refer to it? Is it AlTi or AlTi Global?
Just call it AlTi.
Okay, AlTi. That's how we're going to call it today. Can you walk us through these developments and how your role has evolved?
Sure, you bet. Well, I came into AlTi or into Tiedemann pre-AlTi as an advisor. They had gone through a merger process with a group called Threshold, a multifamily office out of the Northwest that specialized in impact investing for families. Have been very successful, and the family that launched Threshold reached a point where they realized that this was getting very big, that there was a lot of administrative work that you have to do to run a multifamily office well, and that was just not what they wanted to be focusing their energies on. And so they began conversations with Tiedemann around a merger and acquisition, and so that was executed. I was brought in by some of the team members at the end of that process to really be an advisor to the firm around issues of impact, issues around strategy. Did that for 2 or 3 years. And then we came into the pandemic period. My wife and I had moved back to New York City, and Mike Tiedemann, who's the founder and CEO, found that it was not possible for him to work out of his home because he had 3 small children at the time, and it just was not working. And so he was one of the few people who would, schlep up to the office, and our home is just not too far north of there. So I would come down and we would have lunches and just talk about the firm and the strategy and what was happening. And he began laying out a vision that he had around the creation of a large global multifamily office platform that could really meet the needs of families with complex wealth. And what would that look like? And the types of acquisitions that he envisioned, the types of growth that he would like to have us execute. And I kind of naively said, well, this is a really interesting set of challenges, because you have to think about what does that mean in terms of the impact investing practice, and how do you scale that? And also, how do you maintain the culture of the firm? Tiedemann's got a very collaborative, almost a fun environment to work in for a lot of us. And so, how do you keep that in place as you scale this type of thing? And I, again, naively said, well, I wonder, is there some other role that I could play in support of this? Because it sounds interesting. And being an advisor is one thing. Being on the inside is different. And honestly, I was thinking of something like a half-time job or something like that. And he was like, well, why don't you just come inside and become Chief Impact Officer of the entity? That's what I did. And I had never worked for a financial services group. I hadn't worked in a large organization in probably over 30 years or something. It has been a phenomenal ride for me in terms of just being exposed to and a part of that entire process of creating this entity and then laying the foundation for the future work of the firm.
And also there was another acquisition with East End Advisors. How has the company evolved? How is it different than when you entered?
Well, I think initially Tiedemann was a privately held firm that was primarily focused on the United States and ultra high net worth families in the US. As the vision kind of evolved and the mergers moved along, we did 3 mergers with London-based firms, the lead one being Alvarium, which you referenced, have executed several other additional mergers with firms in the US, a firm in Singapore. And so there's a whole series of kind of what's called inorganic growth that we've gone through over the last 3 or 4 years. And each firm kind of brings something different, another spice to the mix, if you will. And so that's been really great to be a part of and help explore what does that mean in terms of the impact work. And then I'd also say we last year took a strategic investment with Allianz Germany and a group called Constellation, about $450 million to really help provide the growth capital that the firm needs to be able to achieve its goal and its vision, really, for not only impact investing, but for families around the world. And a lot of these families, you need to you understand, they have multiple family members all over the world in different jurisdictions. They have different intergenerational needs and challenges. They have different jurisdictional issues in terms of trust structures and corporate structure and philanthropy and everything else. It can get very messy very fast. And so you want to be able to offer those families resources and teams that can really navigate that challenge very well and knows the space, knows how to do that. So that's what AlTi really is bringing forward.
So to give some context, maybe just give a high level overview of AlTi and the activities you're focused on, the clients, the AUM, regional exposure, and number of employees, just so people get a good idea of what the company's about.
Let me start here. Our footprint is US, Europe, Middle East, Asia. We have about 400 employees. We have an investment group of research analysts who constitute a distributed team. We have research analysts in each of those areas, each of those regions. And they make up, well, I'll say another 40 folks. Within that group, we have probably 10 or 12 that are dedicated impact and a significant part of their time and their focus. And then that impact team is able to pull on and receive advice from the larger investment group, depending on particular strategies, instruments, asset classes that we're looking at. The firm has about $70 billion of AUM, of which $5 billion is targeted in dedicated impact investing practices. And the balance is more traditionally managed assets and wealth. We have main offices in London, New York, San Francisco, Singapore, Zurich, with smaller offices in other places all over the world.
If I understood correctly, $5 billion is in dedicated impact, and the balance is traditionally managed, or is it some variation? How do you describe it?
It's a really great area to drill into because a lot of good impact investing is just good investing. And you're wanting to really open the aperture as an analyst to take as much data as you can into consideration when you're looking at a fund manager or a co-investment opportunity, and to understand the context of the investment, to understand not only the financial opportunities and aspects, but things that are thought of as off balance sheet or extra financial that may actually affect how you do as an investment and the context, the risk that you're taking on and the potential opportunities you're pursuing. And so from an impact investing side, you are specifically enunciating what's the broad frame, if you will, of financial, social, and environmental performance that you're looking for. What's been interesting is that 40 years ago, if you were to talk to a traditional investor and talk about these types of things, whether it's ESG or social or more direct environmental, they would say, well, we don't really look at that. We only look at the financial analytics. That's what we got to pay attention to, the financial analysis. Whereas I think today, more and more traditional investors are recognizing that if all you want to do is make money and you're not looking at climate risk for your portfolio, if you're not looking at social factors that might affect your workforce, if you're not considering these things, that you're actually carrying kind of unrecognized risk factors in the deal above and beyond what any kind of particular financial analytics might reveal. And so there was a time, I think, when if you asked folks, and I think still today, you ask folks, do you do ESG? Do you do impact? And they'll say, no, we don't do that. And then you say, well, how do you do diligence and opportunity? And they say, well, we run a financial kind of analysis, and then we look for things that we think may kick that off center. And that would be like climate risk or extreme weather events or these types of things. I mean, if you're in real estate and you're not thinking about the danger represented by unexpected fire events, guess what? That's an important thing. And the reason I say we have dedicated impact as opposed to traditional is that you do have asset owners who say, I want our managers to really come in with that mindset, that orientation, that set of commitments, if you will, to how they navigate and manage investment opportunity. And I think on the more traditional way, you have folks who say, I want to optimize for financial performance, and I'm going to do that by taking into account some of these off-balance sheet factors. But I don't want to be called an impact investor. I don't want to be called sustainability because, for example, in the European Union, if you use those terms, you then have to report out in a whole series of ways about how you're managing, performing, reporting. I mean, all kinds of stuff kicks in from the regulatory side. And so you have what some folks are calling impact hushing or green hushing, where people are actually like using these practices, but they're not like lifting them up and marketing them as such. And so that's why on the one hand, it's a very easy question. You know, like 5 billion is dedicated impact and 70 billion is not. On the other hand, when you really go beneath the labels and look at the actual practices of successful investors, many investors are saying, I want to open that aperture of data. I want to take in as much analysis as I can because that's just good investing.
I want to spend a couple minutes here talking about what does sustainability and what does impact look like in the wealth management area. And I'm asking you that because you're really the first person from a wealth management firm that I've had on the show. And so how would you say that sustainable investment and impact investment in wealth management differs from sustainable investment in other areas of the financial services industry?
We need to think about this in a couple of ways. Before we talk about wealth management implications, we need to start by saying sustainable finance, sustainable investing traditionally has been a broader kind of lens. You can have impact investments that are sustainable, but what happened, I guess it would have been maybe 15 years ago, maybe 20 years ago, is you had a class of investors who were investing capital to do more than make money. They wanted to make money and they wanted to advance a better world. And they started, I think, primarily focused on public markets and screening out bad companies and investing in companies that they felt were good. And we can, again, talk about all the metrics and how that decision-making process goes, but primarily really looking at public markets. And what happened was in the 90s and in the aughts, you had then an infusion of capital coming from a new generation of entrepreneurs and wealth creators who had come out of Silicon Valley, had come out of Wall Street, and were very comfortable with venture investing and with the idea that venture capital was the way to create value as opposed to simply putting your money in public markets, even if you had a well-diversified public market strategy. And so these are folks who said, look, I'm already doing the screened funds and the responsible investing piece, but I want to draw as short a line as possible between my investment of capital and the creation of measurable social and environmental impact. And so I feel that the best way for me to do that is through private markets, through fund managers and direct investment strategies that really are targeted in a very different way. And so that's the first thing to call out, is that within the field of practice, and this is why impact investing itself has scaled so rapidly in the last, let's say, 10 years, 15 years, is because people started connecting the dots across asset classes in a way that 30 or 50 years ago we weren't able to do. Today, you can distribute your capital, you can deploy capital across a host of asset class strategies, each of which have a different risk return impact profile, and do that in a way that is fully diversified and executed on the basis of good fundamental investing practice. That's the context within which then we say, all right, within wealth management, we're going to do a lot of that same thing. The turn that you make is the role and place of the wealth holder in deciding what does it mean to deploy capital toward what ends. And the way we think about it is all capital, all companies have impact. So it's not really a question to my mind as to whether or not you're an impact investor. You are creating impacts by virtue of deploying capital not only in markets, but in communities and in ecosystems around the world. So the issue, to my mind, is really intentionality. And is the capital that you are deploying in the world and in markets creating the type of impacts that are in alignment with who you are, with your values, with your goals, with your objectives, with your purpose, if you will. That's really what the wealth management groups are able to address in a very significant way, is to be able to help families reflect on those aspects and be able then to create and execute investment strategies that really are in alignment with how that particular family wants to show up in the world as well.
What's interesting about what you're doing at AlTi, it's wealth management for clients who hold the wealth. In a way, you're like a bespoke impact tailoring service, which is quite different from an awful lot of the market out there, which are large funds where people invest in the fund, but they probably don't have someone there to sit down and talk with them about what they're going to do. So I guess I'd like to know, what's the process you go through to translate your clients' values ultimately into investment strategies? How do you do that? Because I think that's different than an awful lot of what happens in the marketplace.
All we're doing really is responding to client demand and interest. More and more families really are wanting to move from success to significance and really do more and understand the purpose of their capital as doing more than simply making more capital. In a traditional kind of investment approach, the purpose of capital is to make more capital, right? That's your goal, right? And whoever ends up with the biggest pile of cash wins, kind of thing. But if you're a family and you're looking to manage that wealth over generations, if you're looking to manage that wealth in a way that doesn't destroy the very values and beliefs that the family would like to advance and have really carried forward from generation to generation, that's a very different kind of conversation and set of reflections. And so what we do, and we're evolving this as we go, this is all always in process, as it should be, but we begin with a survey that we do with each individual, not with each family, but with each family member, and say, okay, well, let's review a set of reflections, and that will help both us and you understand, what are you really trying to do? What are you really trying to be about? What is the purpose of your capital in a much deeper sense? Of course, you want to be a responsible fiduciary. Of course, you want to have attainment of various financial goals and objectives. But that's, to my mind, that's almost like a given. That's just the discipline that you use to achieve these other goals that really are more fundamental to who you are as a family and who you are as an individual asset owner. And so the first part is simply engaging in that discussion and that reflection. The thing I will say is that we used to do that really just with the dedicated impact families, because that's a core part. We talk about the impact journey. It's a core part of the impact practice. What we're moving toward now, as a result of this interest and client demand, is really having that kind of conversation with all of our clients and really saying, set aside the language and the doctrine of impact investing. Because a lot of people, if you say, do you want to do impact investing? They say, well, I'd love to do that, but I don't want to lose any money. They have preconceived ideas about what it means to be an impact investor and to do this work. And so let's set that aside and say, okay, that's all fine. But I think in a traditional wealth management practice, you would stay at a, for lack of a better word, a less engaged level of reflection. And you would have financial goals that you would work with the family around enunciating and financial challenges. Whereas I think in the more evolved approach to the work, and I think in some ways it's always been this way, but people just haven't called it out formally. But good advisors, I think, have always really gone more deeply with their clients and explored these other elements. And so we're moving in that direction as well and saying we're working to train our advisors, our culture, our team to not simply start with the financial and the numeric and the kind of, okay, you have this much money, and so a diversified portfolio for you is going to look like this, that, or the other, but really to go one step back and engage in a much different way with our clients and our families around purpose, meaning, and value. And the benefits of that are just phenomenal to see. It's really rewarding to be able to work with families on that basis.
That's compatible with your marketing spiel that speaks about collaborating to connect investments with values. And sorry about the word spiel, but that is what it is. That sounds great, but I just know someone's listening right now and say, what does that actually look like in the real world to get down to some actual investments and placement of money. Can you give me an example that would illustrate this approach that you go through?
To get to the example, I have to say a little more about the approach, because I think to understand the value of the example, you have to understand how we get there. I think a lot of firms have variations on this approach, but we combine a meta framework with a micro analysis of what is out there. We operate with 6 mega trends that we think are going to be phenomenal drivers of both opportunity and risk going forward in the world. And they're not things that would surprise you. They're things like climate risk, but they're also things like interest rate risk, infrastructure, other factors. And we begin there by saying, okay, well, what are the big kind of tailwinds and headwinds that are going to affect investing, broadly speaking? And then what we do is we say, how does that then play out in these different strategy areas, in the different asset classes, and the different types of investment opportunities that we might want to be looking at, so we understand that the context within which those opportunities are being executed and those strategies are being rolled out. So that's one piece. So that gets you down into a discussion around asset classes, diversification, growth, stability, the different areas that you want to be deploying capital within to be able to, again, achieve that kind of purpose, the goal of what it is that you're managing assets for, beyond simply making more wealth. And if you go down another level, then within the impact investing group, we say, look, there's a set of ways to be present in the public markets. There's a set of ways to be present and active in private markets. In the public market side, there's a straight kind of values alignment component to that, where what companies do you like? What themes do you like? What areas do you want to have exposure to? And equally important for many families, what do you don't want to be invested in? What are the kind of things you don't want to have your money, like supplying capital to? And so there's that conversation. So you have a values alignment piece. There's and again, public markets. And then you also then have another area of activity around positive engagement. Okay, what are the ways that you want to be invested in public markets with companies that are creating real value over time and want to be engaged with in order to help them create and optimize more value than what they might have initially simply be focused on. And so we're looking for managers in that category that understand that have a good kind of fundamental approach to investing, but also want to be engaged with the management groups of those companies in a way that they're receiving information and feedback, and that you're really connecting with that company in a different way. So those the two kind of public market frames. On the private market side, we have what are called thematic areas. We've got climate solutions, and we have inclusive communities. You can think of that as kind of people and planet. And what's interesting there is that we then say, all right, so it's great to be concerned about climate, but 10 years ago, 20 years ago, you would have managers who would say, well, this is broadly speaking a climate fund, and so it's a good thing. And I think today what people are saying is, well, your intentions may be good, but we don't want to confuse intent with impact. And so what does the science actually say about what kinds of companies, what kinds of strategies need to be advanced in order for us to have a shot at having an impact on the climate crisis? It's not good enough to just have a water fund. You want to have a water fund that's executing in a certain way. You don't want to have just a renewable energy strategy. You want to have a renewable energy strategy that is also executing in a certain way that the science says needs to happen, right? And we do the same thing on the inclusive community side. We're looking for evidence-based programs that have shown that they actually do change the wealth holding level of families in under-resourced communities, that kind of thing. So these are very intentional. They're very evidence-based. They're very driven by metrics as well as by values and commitment. And then the last category that I'd speak to is the whole area of catalytic capital and blended finance, which is, I think, a really great leverage point, especially for a lot of families. And these would be areas that, for the most part, are, quote, non-conforming to the previous three categories, but still are very interesting as investable opportunities for families and wealth holders. This would be new funds, new firms, new strategies. It could be long-term holding company structures. I mean, a whole host of different strategies that are very financially competitive, but also don't necessarily fit in the traditional buckets. And so those are the options that you would then look at, and you would then go the next level down. The last level would be, who are the managers that are executing these strategies? Firms like ours, we don't sell products. We're not trying to push anything on anybody. We have what's called an open architecture approach. How do you pursue that in a way that is responsible and effective relative to that goal of financial performance with intentional impact?
Are you seeing any patterns with your clients in terms of what they want regarding impact?
Maybe this is boring to others. I find this really fascinating because this is really where the rubber hits the road. And the point is, I think in traditional finance, you have an investment policy statement. It's January. You look at your portfolio and you say, over the course of the year, we want to have this percentage here and that percentage there and that percentage there across asset classes. You go through the year, you see how you've done, and then you rebalance the portfolio and you do it again, right? That's kind of a traditional way that investing works for a lot of folks. And that's not a bad way. Like, you can do very well on that basis. I think that when I think about trends, what happens is we don't think about it as a line or a circle. We think about it as a spiral. And there are core fundamental questions that you're continually touching base on. But where you stand depends on where you sit. And where you sit changes based on the family, their experiences, their perspective on the world, their perspective on themselves. Just as when you're looking external from the family and you look at investment opportunities and markets in the world, markets change constantly. By every second, markets are evolving and changing. Every second, the dynamics that affect financial performance and return change. And so the answers that you get will evolve over time in the same way that you as an investor evolve. And so that's in some ways, that's the power of impact investing practice, because it's what we talk about as mutual impact. It's not simply what are you doing to other people and to other communities and to other ecosystems, but how are you yourself being affected? How are you impacted by the capital that you have and the processes that it brings you into, and your own potential to evolve and grow and become so much more than what you were as an asset owner, certainly, but as an individual, more importantly, as you go forward in this process of wealth management.
How sophisticated are your clients when they first walk through your door? Do they actually know what they want, or do they need a lot of guidance, or do they know what they want, but they just know how much they don't know?
I would say yes.
All of the above.
Everybody's in very different places in terms of how they were raised, their relationship to money, their level of comfort with finance and investing. You know, what they may know a lot about private equity and know nothing about fixed income or public securities or other areas of investing, real estate, for example. And so this is where having the survey piece becomes so important, is that it gives you then that opportunity to really assess where is the client at and what is it that they're trying to advance and what do they know and what could they know more about. And so that's all part of the advisor relationship.
You're essentially custom designing impact strategies for your clients. So aren't you essentially promising clients specific impact outcomes? And if so, how do you predefine impact before making an investment?
Top down and bottom up. It's top down in the sense that families come to us and say, we're very concerned about the state of global ocean health, and we want to invest in ocean strategies and blue strategies. And so what can you help us with there? How would that work? And so we help them navigate that piece. And today, there are managers all over the world with incredible levels of expertise around how to do just that. And so they themselves know, what are the metrics? What's the measure? What am I trying to do? And how do I know whether or not I'm advancing toward that goal as an investor in these managers? And the managers are often investing in companies, right? So it goes through this whole line. And so everybody at each level is reflecting on performance. And what does performance mean? What are the right metrics? Do you have the right systems in place to be able to track and enunciate what those metrics are of performance? You don't want to be in a situation where, as an investor, I'm coming in and dictating to a fund manager what his or her metrics should be, because they're actually the experts. They're the ones who are doing the work. And so it's a conversation. It's an exploration around the strategy, the intent, and what are the important metrics, not just how many metrics can you pile on top of a manager or an investment opportunity.
You've brought up metrics a number of times. We started our conversation today by talking about, are we really achieving impact? So metrics are central to understanding whether we're actually having impact. What do your clients typically want to see in terms of post-impact reporting, and what type of information do you think is relevant for most clients?
There's a couple of ways this plays out. I mean, at one level, clients just want to have a degree of confidence that what they invested in, the strategy that they think is important, is actually being executed with a level of efficacy and intentionality. And so in some ways, that's all they want. They don't necessarily need like a 70, point data set to be able to track a little shift here or a little shift there. They just want to know that directionally we're having the level and type and form of impacts that we think are important. And the reason we think they're important is because we've done a level of research and analysis, but almost more importantly, the managers we're invested in are, again, the experts in the work and know what are we really trying to do? What are the important metrics as opposed to the ones that are just nice to have kind of things? And so it's a conversation in some ways about what's the state of metrics and measurement and analysis within not just the broad field, because that's continuing to evolve and change, but also in the more specific areas of activity that the funds and their companies are active within.
The client doesn't want to get up to their armpits in data alligators, but it comes down to, how do you ensure that metrics are driving real impact rather than just checking boxes and engaging in what you have called cheap impact? Maybe people are walking away with a feel-good experience.
When I think of cheap impact, I think about companies that say, well, we create jobs and that's a good thing. We pay taxes and that's a good thing. Yeah, that's a good thing. That is just a byproduct of doing your business, right? That's not really intentional. You're not managing for job creation or for tax kind of payment or something like that. What we're really looking for within the impact arena is intentional impact. And what is it that you're trying to do? It goes back to the notion of the theory of change that I talked about earlier. What does the data say needs to happen in the world for us to see positive movement forward on any number of issues or challenges? And then are the companies that you're invested in actually in alignment with creating that change that you want to see happen, and that the field as a whole has said needs to happen for change to take place on a positive basis? And so that's really, I think, the orientation that we have to have. And as I said, all companies, all capital have impact, but the issue is it intentional? Is it additive to moving us in the right direction? Or is it simply impact that takes us down a bad path that we're already on?
Let's talk about the elephant in the room that you've already referred to. Greenwashing, there's green hushing, and asset class differences in impact. Help us understand what each of these things are and what are the red flags investors should watch for.
No surprise, this has become a very appealing area to deploy capital into, and people understand that you can actually make a lot of money if you create a large impact fund. You brand it as impact. You can do well and do good. You can have your cake and eat it too. I mean, who doesn't want that?
Enter the charlatans, right?
Yes, exactly.
The clown car pulls up.
That's it. And so that becomes a great opportunity, but also a lot of risk, I think, for a lot of folks in different roles and different capacities. And so what has happened over the past few years is you have a lot of folks in traditional financial services groups who've seen this opportunity, recognize that you can make a lot of money by aggregating capital under the brand of impact, and have sought to do that. And then as time goes on, you can see that they're not really creating sustainable kind of ground level impact, or that the impacts they have are fairly superficial or this type of thing. And so what has happened over, let's say, the last 15 years has been a real movement around getting better standards, getting better regulations in terms of when you use the term impact and brand and impact and sustainable finance and are branding your products accordingly. Do you really have sustainable, investment strategies within those products? Or are you just taking an existing offering and turning it just a little bit and then putting another label on it? And so over the last years, we've seen a number of mainstream firms get called out for this by regulators. And at the same time, we've seen other firms that take this seriously, that really are building impact with integrity, that have done really well in the course of this. And we need to be a little careful, because I think some of it is people look at all asset classes with the same lens and expectation of impact that may or may not be appropriate. And what I mean by that is, when I think of public listed equities, I often hear people say, well, I don't invest in public securities because they don't create impact, right? I only invest in private market or direct invest opportunities. That's how you have impact. And I'm like, it's not whether or not a strategy creates impact. They are creating impact. The issue is that impact appropriate for the asset class. If you think about, for example, the impact that Walmart had a few years ago when they changed their shipping practices and eliminated kind of deadhead runs in order to optimize storage capacity in their transit of products, they did more to change the environmental footprint and the carbon emissions than any number of small local kind of carbon funds may have done. But it's different. It's a public sector impact frame as opposed to a private market local impact frame. It's not that one is better or worse. They're just different depending on what you as an asset owner are trying to achieve and what you want to have. And so if you go back to the idea that capital really just falls across a continuum from philanthropic capital to near market and blended finance vehicles to market rate vehicles, across that continuum, you have hundreds, if not thousands, of investment opportunities, each of which have their own risk return impact profile. And it's not a question of which is better or worse across that continuum, but rather, what are you as an investor trying to do? What are you trying to achieve? And what then becomes the right mix of investable opportunities that help you create the total performance that you want to have with your portfolio's capital. And so that's the best part of the work, is really, it's not a process. It's not a one and done kind of thing. It's not a set it and forget it kind of thing. It's a set of considerations and questions that you as a wealth holder have that you navigate through over time. And the answers can look differently in different points of time as well. And so that's where the engagement process with the wealth holder on the part of the advisor becomes so critical. And so empowering, I think, on both sides.
In 2011, you co-authored a book titled Impact Investing, Transforming How We Make Money While Making a Difference. And in that book, you state impact investing is what we do, blended value is what we create. So define blended value and explain, how does it serve as a conceptual framework that unites economic and social and environmental value rather than viewing them maybe more traditionally as separately?
Well, I would go back to the previous discussion about the reality that we operate in a world that asks us to accept the idea that value is bifurcated, that you have to either do well or do good. In the old days, in my 30s, when I would talk about these issues with businessmen, they would say, and they would always be businessmen, they would say, if you try to combine social positive good with business, you're going to have a bad business and no positive social good. and their attitude was completely like, that's what nonprofits are for. And that's not what business is about. We're here either to optimize shareholder return, and we're here to optimize profit. And the fact is, however, that all companies are in essence blended value companies, in the sense that is the nature of value, is fundamentally whole. It's non-divisible. It is integrated. It is not separate into parts. As much as we think that we can operate that way over time, we consistently see the fact that companies have social impacts. and nonprofits create economic value. So it's kind of like a priori, we are working in this integrated frame. Now, whether or not we want to recognize that is the second kind of point. But at its core, the nature of value itself is whole, it's non-divisible, it's a blend of social, environmental, and financial factors. And so when we recognize that and combine that with this notion of clarity around the purpose of capital, that's when we then are really released to be able to understand the full power of the practice of investing, and that it can generate different levels of financial performance depending on what we're looking for. And it can have various types of social and environmental impacts. And that is true for every organization that's out there. And so that's the conceptual piece. How it plays out can differ based on where different folks are, what the intent is, how we're thinking about it. But it is a both and at the end of the day. It's not an either or.
Could you give me a real life example of how an organization can maximize their total value creation potential?
There are certainly more and more of them out there. And again, anything I say during this entire conversation should not be taken as investment advice or guidance or anything like that. Let me just say that right up front.
Of course.
I think about a company like Patagonia, right, which creates high value, high quality outdoor sports gear and goods. And then we'll have ad campaigns. They'll have one of their jackets, a nice picture, and it says, don't buy this jacket, because they want you to get the most out of the products you already have, the clothes you're already wearing. When you're done, come buy a new jacket, but don't just go out and buy stuff because you can buy stuff. They also, if your jacket is torn or if your backpack is damaged, you can send it back to them. They will repair it and send it back to you so that you'll continue to use it. It's a very kind of environmentally oriented and conscious organization. And then lastly, they took their ownership structure, I guess this was 2 or 3 years ago, and moved their ownership structure into a trust of some kind in order to align the planet with their profit and to have a voice, if you will, of the planet at the board level as they're making business decisions. And so I think you can go down the list of that organization and see how in different levels of the organization, they're operationalizing what for me is a blended value kind of frame. Another example would be a group out of Scandinavia, a housing group called Home.Earth. And they do a great job on sustainable living communities for mid-income renters and creating accessible housing that's high quality, that's very good. That alone is a good example of a blended value approach to business development and real estate. But they've gone a step further, and they make it possible for renters in their communities to have ownership shares of the holding company. That's the management group that runs the rental units and runs the buildings. And so you have an opportunity for renters to begin to engage in wealth creation and have a vested interest, if you will, not only in that community, but in their own future as individuals. And so it also operates as a kind of wealth generator, a wealth creator for families that are middle income and looking to want to augment their wealth that they have. So that integration of kind of an environmental economic development strategy with a sustainability strategy, with a affordable housing strategy, all comes together pretty nicely as an example of blended value as well.
I've heard you say that it's all too common for impact investors to focus on the how of impact investing, often at the expense of the why of impact investing. Tell me, what are some of the key why questions that you think those who are practicing blended value should be asking?
It's an interesting set of questions, because what happened for me, and I think different people come to this at different points in their own kind of process. For me, I had done this work for 20 years, 25 years, something like that, and was viewed as an expert in the field. I'd co-authored, 7 books on impact investing and social entrepreneurship, widely speaking about the topics, all this kind of stuff. And in working with my families, I realized that I was only working with families that were doing 100% total portfolio management. So this is like the cream of the crop of impact families, right? That all in 110 degrees, if you will. And I realized that in some of these conversations, and I would sit on the investment committees for these families, and we'd look at each other in the portfolio review, and we had done everything right. Okay, like we deployed effective managers, we're getting the impact reports that look promising. I mean, everything's going well. But you would still, in some of these meetings, look at each other and be like, yeah, but what's happening? Like, what's changed? Is anything really different? Like, what are we really doing here? Like, what is this about, kind of thing? And I think that made me realize that we had focused in some ways too much on the tool and not enough on the task. And I think that for the field, we have all these discussions about this instrument, this investment strategy, this metric, this definition. We have very few conversations that stop and have us step back from the whole thing and reflect on, well, what is the fundamental purpose of capital? What are we really trying to do with our capital beyond how we're trying to do it? And so that's where I got into this whole thing. And so I think there are a couple of levels that this conversation then plays out in terms of what are the questions that you have to have. I think the first thing that we need to do is really recognize that we should not lead with our answers. And part of what's wrong with American society, part of what's wrong with impact investing is that too many times we come on to an answer or a solution and we hold it up and we say, this is what we need to do, right? And so if you're an entrepreneur and you're very committed to your business strategy, you have the answer to whatever the issue is that you're trying to solve in the market. This is the best thing to do. If you're a fund manager and you have a fund strategy around alleviating poverty in the world, you have your approach, you have your strategy, you put your deck together, and you have to have that as the answer that you're defending, right? And so it ends up putting us in oppositional places. It's like, I've got the money, you have the answer. You need to convince me that your answer is better than this guy's answer. That's the cycle that you get into. That doesn't allow for the possibility that maybe you're wrong. It doesn't allow for entering the process from a place of humility as opposed to confidence that you're just so right and everybody else missed everything else. The purpose conversation opens up some space for sitting more deeply with the questions, out of which then you can see the answers in a different way. I have heard that he said this, and I've also heard that he never said this, but Albert Einstein is said to have said that if given an hour to solve a question that his life depended upon, that he would take 55 minutes to reflect on the problem, and after which he would only need 5 minutes to get the answer, because the answer just reveals itself if you stop and actually think about what are the fundamental kind of issues, right? And I think it's the same thing here. I think that's what we need to be doing.
In 2018, you published yet another book called The Purpose of Capital: Elements of Impact, Financial Flows, and Natural Being. In this book, you explore how our understanding of value has evolved over centuries. How should we be thinking about value creation beyond generating financial returns and so forth? Talk about that. How should we be thinking about value creation beyond financial returns? And how is this topic increasingly being considered by wealth holders around the world?
Well, first off, I should say for people who are interested, you can download free ebook versions of The Purpose of Capital. So this is not just a pitch for my last book. So if you go to purposeofcapital.org, you can get the book. And Scott, maybe you can put the link in the
I'll put the link in the show
show
notes for sure.
I would also say that this is not an easy read. It is not a 5 points to purpose. You just flip through it and get your takeaways and you're off to the races. What I'm calling for is really a fundamental reconsideration of our understanding of the purpose of capital, our understanding of the nature of value, in some ways, our understanding of our lives. What happened for me is that I woke up during one of my periods and realized that I'd been promoting this concept of blended value for years, but had not really stopped to go back and understand, how did we come to this place of bifurcation to begin with? Like, how did we begin to think that you could separate out kind of social and environmental from financial considerations of value? And so I began doing research on the history of finance and economics, and that took me to research around the broader sphere of kind of social and political history, which took me to religious history, which oddly enough took me to the sciences and scientific history of development, which brought me back to religion. And so all I did for like 2 years was just read. In essence, I wrapped up some of my advisory work and bought back my time so I could really read a lot more. And what I found was that all of these questions and issues are actually things that humanity has struggled with for millennia. And none of this is new. Arnold Toynbee, the historian, says every generation thinks of themselves as the pinnacle of human development. And the irony is that on the one hand, they are, like they're the latest iteration, the latest turn of the wheel. And on the other hand, they aren't, because every generation finds itself in that place. And so the real question is, how are we pulling forward the knowledge, the perspective, the wisdom of previous generations in order to help us understand more about where we find ourselves today? And so for asset owners, I think what happens is you get folks who are incredibly successful, and by all measures, they have a lot of money, they have accolades from people, they get the awards, all this stuff. And yet there's still an inherent at core kind of question or doubt, or is this it? Is this all? Right? And I think you're talking about people who are wanting to move from success to significance. And that's really what this conversation is about, is how do you really step back from your own hubris? How do you not believe your own press release and your own ego? And how do you open yourself up to another level of reflection about your relationship with wealth, but also your relationship with your family, with your relationship with nature and the planet? All those things are all part of this as well.
How does this cascade down when we get down to the millennials and Gen Z? This same kind of questions are being asked, aren't they?
They really are. And I think it actually does begin with the first gen, because a lot of these folks are realizing that over the years, the conversations about wealth have degenerated to discussions about who gets how much and how much money do we have? What do I do with my money? You gave more money to Bobby than you gave to Sue. And so what's that about? All these conflicts and confusion around the wealth. And I have found in many cases, first gen family members are using the impact investing conversation as a way to re-engage with second and third and fourth gen family members around what really matters, like what's really important to us. What are the values that make our family different from other families? What are some of the values that may have contributed to the wealth creation, and why are they important to bring forward in your generation? And then to your point, the fact is Gen X, Gen Z are coming to the table in a very different way from the way their parents did. They're coming to the table asking some pretty profound questions about not only how should they handle the wealth, but again, what is the purpose of their wealth? And there are some very hard conversations to be had. I have not had this experience myself, but I have heard of families where the third and fourth gen family members are holding the first and second gen family members accountable for destroying the planet and for giving them a planet that is uninhabitable or that has these issues and challenges, and for not being engaged enough in problem solving and making the world a better place for their kids. And it can be a very tough discussion. And it's a discussion that can also be extremely rewarding, because it's how families can stay together and be connected. And so in our case at AlTi, we have a very robust family education and governance program that works with our clients around many of these same issues.
I've got to talk about the music video that your book, The Purpose of Capital, inspired. It's not often that a book on impact investing inspires music videos. Tell me the story about this.
It's a little embarrassing, actually. So I finished the book, and we were waiting for the full publication and stuff. And my wife is a videographer, a media journalist. And she was like, we've got to do a video for the books that help promote the book, help people understand what it's about, all that kind of thing. And she's Norwegian. And we spent a fair amount of time, actually, when I was writing the book back in Norway. And so we got a camera. We went back to the cabin in the mountains and she took footage of me in different positions, looking very deep and thoughtful, hiking through the mountains of Norway, all this kind of stuff. And the idea being that we would go back and then I would read excerpts or something, being very deep and thoughtful. And we came back and we looked at the footage and we both just cracked up. It was just ridiculous. Like, it's not something that I would ever want to share with anybody, and just looking so pretentious. No, it's just ridiculous. So in any event, so we immediately were like, all right, well, we're not going to do that. And then it just happened that we were having Thanksgiving dinner with my brother and his family, and my niece, who at that time was at Stanford. It turned out she had read the book. She basically had stolen my brother's copy, because my brother, I don't think to this day, has actually read my book, but she read it, and her name is Jackie Emerson. She was in the first Hunger Games movie and has also been a musician and a singer and done a lot of different things in the arts. And we said, look, we're not quite sure how to get at it, but what would you think about writing a song about this stuff so we can take a completely different entree to promoting these ideas and the book itself? She loved that. And so we said, look, we'll give you, like, I can't remember, I think it was $5,000 or something. And she's in LA. She's got a lot of friends who are either musicians or actresses or what have you. And they did a Mickey Rooney thing where let's put on a show. They basically produced this whole thing, and she wrote and sings a song, and it came out phenomenally well. I was really impressed. I sent her like one email with like 4 or 5 paragraphs on, here's key points that I'd like the song to address. Dualism, humanity's separation from self. I mean, like all these different philosophical ideas or concepts. And she did a great job, I think, presenting all that in the span of like a 3-minute video.
Honestly, when you sent me something about that and I thought about an impact investing music video, I thought I'd probably rather get my teeth drilled. But actually, it's really good, very original. I'm going to put a little bit on.
Yes, please. No, that'd be great. I have to warn you, once you get it in your head, it can stick in your head. It's got a kind of a catchy hook.
I have to agree with you. It's been knocking around here. Let's see here. So this is like Mr. Monopoly Moneybags. That is your niece, right?
That's Jackie right there.
Instead of focusing on what money buys, instead of buying into financial lies, there could be more to what our capital does. We started saving up for what will save us. We redefine what money is and can do. We thought of capital as energy too. We thought of cash in a completely new vein. We utilized our funds for impact, not gain. Over the past centuries.
That's really good, huh? I mean,
thank you. I'm glad you appreciate it.
Well, it just didn't happen, huh?
They make equity, but now we see the world they need for us to change. Where our spare change is invested, last in future ages. Our planet falls to dust.
She's got a voice.
Their planet will combust, so we must do this task, which is to ask what if all sectors could unite with one view in mind. Public and private entities were combined. Profit and not-for-profit had the same goal. Pardon with dollars made you part of a whole. We reframed how we see our capital held. Value of money isn't money itself. We coin new ways for coins to appreciate. Appreciation that, hey, that's really great, thanks.
I think the idea was really original. Did she write all this music and everything?
She co-authored it with one of her friends. They worked together on it. And you can see it's got a whole 1980s theme because I guess that's at some point was very big with her generation. They really liked it. Has a feel of a VHS video. So anyway, no, that was a lot of fun to do. I was pleased.
Yeah, I know those things don't just happen. That was quite good. You have to give her my compliments on that. And I'll put the link to that video so people who are interested can actually go and watch that. It's worthwhile. And do you have any footage from the Norwegian landscape with your voiceovers?
No, that will not see the light of day.
I read that and I could just imagine you standing pensively looking over the mountain and saying your consciousness opens your own phenomenon while the eternal stillness within you embraces unparalleled potentiality of impact investing.
Good Lord. Even right there, that's more impressive than what I was coming out with. So
Well, I could just imagine what probably the idea was, but I guess sometimes when you see some of these things,
it's in your head, I got to say.
how has your understanding of blended value evolved since you introduced the concept in 2000? And what are the most significant shifts in the field that have impacted its relevance today?
I really thought of it as a kind of a meta framework for how we need to think about things. The people who funded my research, at the time I had an appointment, I had started at Harvard Business School and then over at Stanford Business School when I was doing the research. And the folks who had funded it, when I concluded the first part, which is a blended value map, we went through a whole mapping exercise, they said, you should create a blended value institute and we'll give you capital to launch this thing. And you'll be able to convene people and have meetings and all this kind of stuff and promote the concept because it's a really important concept. And I said, well, how much money are you going to endow the institute with? Because that's important. They said, oh, no, we'll give you like 3 years of operating support and then you can go raise money to keep it going. And I was like, that's the trap that I fell into with Larkin Street Youth Center. Now, I'm not going to go that way. And so instead of thinking that I should create a new organization to tell people we should think differently about organizations. I decided that what I would do is simply go find people that I felt were exploring different parts of this kind of new way to think about organizations and place and all that. That's really how I got into the advisory and consulting role, was not so much promoting a firm or an organization, but promoting a set of practices and trying to find folks who, in their own language and in their own way, we're exploring some of those same ideas. And so I think the way that it's evolved over time, for me, this is just a reality. Value is integrated, it's whole, it is non-divisible. And so as we look at the world and we look at different both breakdown and responses to breakdown, to my mind, you can see the validation of that construct and the idea that we need to be thinking about things on a more integrated, holistic, and blended basis. That's really how I think it's evolved. It's in some ways, it's like a ship that has been tilted over because of our emphasis on financial capital in a very bifurcated way. And the ship is wanting to center itself again in a more holistic way. And I think that's where we're moving toward over time, even in light of some of the current challenges that we have before us.
And you were doing this, I have to really draw everyone's attention to it, really early doors of impact. I mean, back in the 90s, it wasn't really even a word. It wasn't a thing. How should we think about the future of impact? How should we think about where it's going?
I should really say, I feel like I'm part of a generation of folks who came up at a point in time where these ideas were being explored and reflected on. And I was, fortunate to be in a place where I could try to pull them together in a certain way. And again, at the blendedvalue.org website, there's a whole host of papers and articles and things on blended value. I think that where it's evolving is both in tension with what's currently happening and advancing better ways to think about it in ways that matter. And what I mean by that is, so this is going to sound a little out there, but in Buddhist thought, there's a notion of reverse movement, right? So in Buddhism, everything is one, everything is connected. And reverse movement posits that as you advance in one area, it unleashes energy and forces in the opposite direction. And so as you progress, you're always having to adjust and be fluid in terms of how you operate, because what you do will unleash other elements of energy that will then try to countermand what it is that you're promoting and how you're wanting to be in the world. And so I think in some ways, when I think about what is today, it's almost a validation of impact investing and integrated value and blended value that we see what has happened in the world and some of the divisiveness and some of the pushback and some of the futile effort to get rid of the reality that we're one community with many parts and many actors, but we are one community. I think those ideas are just, if you look at the history of humanity, it is this struggle between our being one and yet our operating as parts. And it's the struggle of the pieces needing to explore how to assert themselves and respect and be true to themselves. But also at the end of the day, we're all one humanity. And so we're always coming back to that central lesson, if you will. And I think that's what you take away from a lot of certainly the wisdom literature. But if you look at the experience of humanity over time, we are always struggling with this parts to whole kind of question. We're struggling with this process of, in Buddhist terms, being and becoming. Where on the one hand, we're fundamentally broken in a lot of ways in terms of how we show up in the world. And on the other hand, we're continually in evolution toward what we're called to be in the future. And so I think the future of impact investing in some ways will not reference impact investing at all. It'll just continue to be more and more folks who recognize that to do good fundamental investing means that you think in a more integrated, holistic way. It means you understand the value proposition of firms as being more whole. And you can't think in terms of externalities because there's no away. There's no other place you can throw things that aren't working in your company, or what gets expelled out of your company is exactly what you end up having to breathe in the parking lot, or what your kids have to navigate through as they go about their lives. It's all one. It's one part.
Jed, I've got a few last rapid fire questions to wrap up our talk here. So just give me whatever comes to your mind, or if nothing does, feel free to take a pass. That's okay too. If you had to name the one most important challenge in the impact investing space at this time, what would it be?
I think it's communication. I think it's the need to have the right words framed on terms that other people can hear, receive, and understand. That's a key part of the challenge we have today, is simply talking about it, and in some ways not talking about it, letting us sit again more deeply with these fundamental questions that we're called to explore.
What do you know now about impact investing that you wish you knew 25 years ago when you started Blended Value?
Actually, I've often thought of this because I remember when I was like 30, coming into the world and seeing these guys who were like 60 and 70. And I was like, you don't have a clue. Like, you fundamentally don't understand. Like, what's going on here? I know what's going on. Like, get out of my way kind of thing. And in fact, I often have thought that if I met my 30-year-old self today in my office, I'd have to throw myself out of the office because I'm just like, I was very self-impressed at a level that I find embarrassing. And yet, having said that, I love my 30-year-old self. I think if you're 30 and you don't believe passionately about something, you don't have a vision about what you're trying to do and be in the world, then I think you need to take some time and regroup, because I think that's what you should definitely have and be about in your 30s. So I think that's a big part of it, is the level really of humility in terms of this process and conversation, and trying to bring a more grounded perspective to not only the work that we're all involved in, but to how I'm showing up in the world as well. To have Walter Bergman talks of ambition, where you have very ambitious goals, but you approach them from a posture of humility, because at the end of the day, whatever we do today in 5 or 10 years, we'll look back at and think, well, there's a good reason maybe that's wrong. We need to change it. We need to do something else. So you're always in that process of being and becoming again.
You don't have to name names, but can you describe an investment that you made or advised on that you were convinced of at the time you invested or recommended investing? It ticked all your impact boxes, but in the end, it didn't turn out. And what was the lessons learned from that experience?
Well, so the first book that I edited and then produced and wrote large parts of was called New Social Entrepreneurs. And it's a 420-page report basically on the fund that George Roberts and I had launched, and the early lessons learned about some of the initiatives that we had backed. And there are, I'm not even sure, maybe 10 or 15 case studies. And each case study ends with, here's the 5 to 10 things I really wish I knew before I lost this money. It's a really different kind of read. And again, you can find that online as well. But I think there's just too many. And I think part of the issue for me is that, having helped start funds, having advised families, worked a lot through this space, I realized that a lot of this, you have to, in addition to being smart and thoughtful and prepared, you really have to be lucky. Like, sometimes markets move against you. They move in your favor. It's not that you're so brilliant. It's just that you happen to fucking be in the right place at the right time. And I think that's just the way it is. And the sooner you can acknowledge that, then all your hard work and everything else you can take credit for. But I think a lot of folks think they're actually really brilliant, when in fact, there's a number of things that went into their success. It's not just them and their great intelligence.
And now the converse of that, can you describe an impact investment that you had some level of skepticism about, either at the time you recommended it or invested in it, or maybe that you ultimately recommended to pass on it, but in the end, it turned out way better than you thought, had way more impact, and you were pleased you had invested, or if you had passed on it, you wish you hadn't, and what was the lesson learned from that experience?
There was an organization that was being launched 20 years ago that when the founder of the organization came to talk to me, and she said, look, I've talked to a lot of people. Everybody says you got to talk to Jed. He's the guy who could really help you think this through and figure this out and all this kind of stuff. And so we met for like an hour, and she was very passionate, had a lot of good experience, very talented. And I was just like, this is just not going to work. Like it was really predicated on philanthropic capital driving a lot of investment practice that I had just spent like 10 years in the foundation community trying to get foundations to do a lot of this. And they were not having any of it. Right. And I just told her like this, don't even bother. Like this is not going to work. And she took my feedback, and we had a really good interaction about the challenges and how she should think about it and try to overcome them. And God, if she didn't go out and create this multi-$100 million entity that then has been very successful over the last 20 years. So I think that's my claim to shame is having like doubted that was possible.
Is this no name?
It'll be no name, just to spare myself the humiliation.
I'm pretty sure I know who you're talking about, but anyway, if someone wants to get into the impact investing space, where would you advise them to start today?
I think I would advise people to just read, like not necessarily launch themselves in with great fanfare and announcements and all that. I'm bemused by the number of impact investors who lead with a press release as opposed to their practice, if you will. And I think that we actually know a lot about how to do this and the complexities and the issues. It's a field that has a lot of very opinionated people, and you can find folks who believe what you believe, and they can back you up and buttress you, but you also need to understand the larger context of the discussion and the debate and understand that your perspective on it will change over time. And so I think the first thing is just to learn what's already there and then see, what do I do to build upon that and take it to another level? That's the first thing. The other thing I'd say is there are networks now out there that didn't exist 20 years ago. Things like Tonic, which is Angel Network for impact investors. There's GIN, Global Impact Investing Network. There's a lot of regional things going on. There's things that are straight up seed and venture that could be turned to impact, but aren't branded impact. I mean, that's one thing I'd say is don't be limited by the language of impact investing. Look for the people and the practices that are doing things that you think are interesting. Whether or not they call it impact is kind of irrelevant, quite frankly, to my mind. And so that's my final, I think, piece of advice.
I often quote you from our first talk where you say everyone's an impact investor. Just depends, are you making things better or not? And I actually bring that up a lot because it puts things in perspective. Listen, Jed, it was great to catch up with you today. Thanks for coming back on. I really enjoyed it. Now, tell everyone your websites and social media and the best way that they can find out about all the great and different things you've got going on.
I'm on Blue Sky. I'm still easing my way into that community, but you can find me there. The best way is to go to the blendedvalue.org website, which links to the purposeofcapital.org website and has a lot of materials and other things that I hope will be helpful to folks as they proceed.
And what about AlTi?
AlTiGlobal.com. I think it's just AlTi.com for the website. So, but you can search that, and we're on LinkedIn and other things as well.
And what's the best way for people to contact you?
Jed@blendedvalue.net.
Okay, Jed, thanks again.
Thank you so much. It was great being with you again, Scott. I'll look to see you in another 5 years.
Hopefully before. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.